Assalamualaikum warahmatullahi wabarakatuh. Hi, my friends and my honorable lecturer. I'm Muhammad Mukhsin. Would like to present you about my paper about the influence of the executive compensation toward earning management. The content of presentation, the first is Chapter 1, Preliminary. The second is Chapter 2, Discussion. And the last is Chapter 3, Conclusion. Okay, we going to the Chapter 1, Preliminary. The content of the Chapter 1 is the background, and problem statement. The first is the background of my paper. Earning management is an action taken by managers to intervene or manipulate a financial report with certain goals. Usually, earning management is done in order to fulfill their personal goals of manager. The reason manager can perform earning management is because of the accrual accounting principle, which allows the manager to choose certain accounting method so that these opportunities can be misused for the certain purpose. The purpose of establishing the company is to obtain the profit that are used to satisfy and prosper shareholders. And on the other hand, managers who manage the company want to have a higher compensation. Conflict arises when the manager demands high compensation for their performance. On the other hand, shareholders are dissatisfied with the return they receive for their investment. Shareholder dissatisfaction indicate that the company performance is not what they expected. In other words, the executive is not doing well. This is reflected in the financial statement presented by the company. As we know, the earning is the main concern of the user of financial statement, or the earning is the part of the income statement. The income statement is the financial statement that interprets the result of the company's performance in certain period. The profit and loss report is the most important report for shareholders because they can use the report as the basis for assessing the company's performance. If the financial statements do not present the true condition of the company, it will certainly cause shareholder or stakeholder to misunderstand the interpretation of the company's financial statement. Of course, it will cause them to make a wrong decision that will lead to losses. In general, the performance expected by shareholders for their investment in the company is performance that result in high return. In other words, shareholders expect to companies they invest in will generate high profit so that they can provide them with the high return as well. To meet the expectation of the shareholders, it is possible for manager practice earning management by intervening the financial report so that the company appears to be generating high profit in order to give the executive impression of good company's performance and increase the compensation that will be received. Pressure of the compensation. Since the signing of the contract with the company, the manager is responsible for doing their best, so that the manager feels pressured by the profit target that must be achieved. This condition is vulnerable for the manager if they cannot achieve the target that have been set, so that they can manipulate as if the targets were achieved. The next is problem statement. As the most important part of the financial report, managers should report the actual profit, that there are not misunderstanding that will cause the loss to shareholders and stakeholders. So in this paper, we will discuss about the first is what is the concept of the earning management. The second is what is the concept of the executive compensations. The third is what is the influence of the executive compensations toward earning management. We move to the chapter 2, the discussion. The first is the concept of the earning management. In general, earning management is the act of the management interpreting the financial statement. The financial reports that have been interpreted by will certainly lose their reliability, which can lead to misleading users. According to Scott 2015, earning management is the choice by the manager of accounting policies or real action affecting earnings so as to achieve some specific reported earnings objective. The definition of the earning management is also put forward by the Balkawi 2004, who sees the earning management as the deliberate intervention in the external reporting process with the intention of obtaining some personal benefits. From this definition, it can be concluded that managers have opportunistic behavior in the managing the company. In the application of accrual accounting principle, managers have freedom to choose and use alternative or accounting methods available in the preparations of the financial statement so that the company profit can be adjusted to the interest of the manager even though the profit generated do not reflect the actual condition of the company. The next is the earning management pattern. Scott 2015 divided the earning management pattern into four. The first is take a bet. Take a bet is the pattern that shifting the expense in the period. It can be future expense are recognized for the present or the present expense are recognized in the future. This will be ordered sacrifice the present for the realization of the future income goals. The second is the income minimization. The second is the income minimization. The second is the income minimization. Dissimilar to the take a bet but less extreme, such as the pattern may be chosen by politically visible firms during the period of high profitability, and when the firms seek legislation to protect themselves from the foreign competition. The policies that suggest income minimization include the rapid write-off of the capital assets and the intangible, and the expensing of the advertising and R&D expenditure. Income tax considerations such as LIFO inventory as they are currently allowed in the United States and provide another set of motivation for this pattern. The third is the income maximization. This pattern of the company's managers tries to report high income for the purpose of getting bonus. The income maximization pattern is carried when the company experiences a decrease in profit. Usually, this pattern is done with the aim of showing good performance by manager so that they can get high compensation. In addition, this pattern is used to get positive sentiment from the stakeholders such as investors, lenders, and suppliers so that they can continue the assets of the company's conditions stable and with good prospects. The last is the income smoothing. The earning management patterns of income smoothing carried out by making companies' profit look even the period to period so as to reduce the level of fluctuations in the company's earning. Next, we continue to the technique of the earning management. The technique of the earning management can be done with three techniques, namely. The first is take the advantages of the opportunity to make accounting estimates. The management affect the earning by making decisions on the accounting estimates that could indirectly affect the earning, such as the estimates of level bad debts expense. The level of bad debts will be borne by the company. Manager can manipulate the estimate of the uncollectible accounts so that if the bad debts are large, it will be reduce the profit and it will vice versa. Furthermore, the manager can manipulate the estimate period of the depreciation of fixed assets or the amortization of the intangible assets. Thus, the manager can reduce the depreciation expense so it has effect on the profit. If the depreciation expense is higher, it will reduce profit. The next is changing the accounting method. Manager can use the variety of the accounting method so that it can be affect the earning, such as the choice of the depreciation accounting method. Depreciation method that can be selected are the sum of year digits, straight line method, and double declining method. In addition, the manager can also use the cost of goods sold recognition, such as first in first out. It will be changed to the weighted average, or the weighted average will be changed with the first in first out method. The next is shifting the period of expense or income. This technique is similar to take a bad pattern by shifting the expense of the companies or the income to another period. The difference with the take a bad pattern is that the take a bad pattern is usually only shift the expense. An example of this technique is the companies speeding up or delaying expenditure, or the companies delay to record the research and development costs until next accounting period. This will lead to the increase in the current profit. If the research and development expense is overstated, well, it will be effect to the current profit will be decreased. Furthermore, by speeding up or postponing the promotional expense until next period. The next, the speeding the product delivery to customers. Adjusting when the sale of unused fixed assets. In generally, This technique still manipulates the account and the income statement, namely the manipulation of the income, it means of the revenue or the expense of the company. The next is the motivation of the earning management. The first is the bonus purpose. Like I explained before, the bonus purpose is the main reason for the manager because it's described in the agency theory. The manager intends to fulfill their needs and welfare. So this motivation is the most important reason for the manager to manage earning. Manager who knows all the information about the company's profit compared to shareholder or the user that will tend to be selfish. The imbalance information is used by management to manipulate the profit so that manager can maximize the company's profit with the aim of getting the incentive in the form of bonus or the compensations. The second is the political motivation. In addition to aim getting bonus, the management conduct the earning management for political purpose. It means the management will perform the earning management with the aim of the influencing the user's decisions. The earning management is used to reduce reported earning in the public companies. So the companies tend to reduce their reported profit due to the public pleasure, which result the government setting the tougher regulations. So the third is the taxation motivation. Taxation motivation is the companies carry out the earning management with the aim of making tax saving. So the companies want to pay tax as minimized as it can. The pattern for tax purpose is usually used by the company is the income minimizations. The management minimize the profitability so that the tax that must be paid to the government also smaller than it actually is. The next is the CEO change. Management usually perform earning by the CEO who is nearing his retirement, usually done by the increasing profit in the aim of the getting a bonus of the retirement CEO. And the next is the initial public offering purpose. The companies take their first stock offering on the stock exchange and do not yet have the market value have tendency to conduct the earning management. This is done with the hope of increasing the company's stock price in the future. The last is the to meet the expected The last is to meet the expectation of the investors. All information relating the company must be conveyed by manager to investor as the form of the manager's responsibility. Therefore, the management carries out the earning management with the aim of the investor still assessing that the companies perform well according to their expectation. Thus, the investor do not withdraw their fund in the company because the company's return can be provide the return that they are expect. Next, we move to the executive compensations. Compensation is a form of money or goods are directly or indirectly received by employees in return for service provided to the company. The compensation in the form of money, for example salaries, is paid the currencies to the employees. The compensation in form of goods, for example salaries paid in kind. Until now, executive compensation is still considered as the effective way to improve the employee's performance in the company. It is said to be the effective because when the executive in the company are given compensation in the accordance with their duties and responsibilities, the executive will have confidence in the company where they work, so that the executive will try to improve their performance and maximize their expertise and the resources that he has. Compensation that is allocated to the board of commissioner and director is usually refers to the executive compensation. According to Scott, the executive compensation plan is the agent's contract between the company and the company's manager that tries to balance the interests of the owners and the manager by basing manager compensation on more actions of the manager effort to operate the company. Meanwhile, according to Jensen and McLean, 1976, compensation is the service provided the company's owners to the management. Most of compensation based on the performance of the employees. In this case, has two dimensions of the measurement that are net income and share price. Based on the description of the above, so it can be concluded that the executive compensation is the feedback or reward given by the company's the executive as an appreciation of their performance in the form of salaries, allowance, and the other form of the remuneration in the accordance with the agreement between manager and shareholders. There are several criteria that making compensation policies for the employees executive. Namely, the first is the cost of living. Cost of living, the first criteria that must be considered in making compensation policy. This must be considered because the main purpose of working, the people wants to meet their needs. So the cost of living indicator in the providing compensation is basically the inflation. Because of the inflation, the needs of the people will hike or increase in the year to the year. The next is productivity. The second criteria is the important things that also deserve attention. The productivity of employees will have a direct impact on the company's earning. So with the increasing the productivity will certainly affect the increase in the company's income. Next is commonly applicable with scale. Furthermore, that must be considered is making the company's compensation policy must refer to the minimum wage that has been set by the parties such as governments or professional organizations related to the field of the employees. The next is ability to pay. Of course, it is mandatory for all organizations to always take into the account the amount of the cost incurred to pay employees compensation wage. This is important part because they also related to the efficiency of the companies. So the last is motivation for the employees. By providing appropriate compensation, It will be certain motivate employees to improve their performance. A good company will always attract prospective employees by offering a number of compensation to work in their company, as well as retaining its employees to feel at home working in. The compensation can be divided into two. The first is the short-term compensation plan, and then the second is the long-term compensation plan. In the short-term compensation plan, there are some of the system. The first is total bonus pool. This total bonus pool system shareholder for the formula used as the basis for calculating the bonus amounts. In this system, compensation policy is made on the company's profitability in the current year. It is important to pay attention to ensure that the total compensation paid to executive is competitive. There are some of methods in the system. The first is determination of bonus, which equal to the certain percentage of profit. So with the formula, bonus equal to X% times with the net profit. The second is the bonus method is based on a certain percentage of the profit after the earning per share minimum. The level is reached. This method does not take into the account the increase of reinvested profit. The formula is the bonus equal to X% times with the net profit minus with the minimum total EPS. The next is carryover. The system in the short-term compensation plan that regulates that every year there is a bonus distribution, and the bonus distributed doesn't depend on the amount of profit. The advantages of the system are: the first is method are more flexible because the payment of the compensation is not determined by the formula and the use of assessment of the board of commissioner. The second is the method can be reduced the fluctuation that occur when the bonus repayment are based solely on the resulting amount from the formula, which is calculated annually. The last is deferred compensation. In this method, the company delays the payment of the executive compensation for the certain period. The advantages of the method: the first is the managers can predict the considerable accuracy of the cash income in the coming years. The second, the first payment can smooth out the cash received by manager because the impact of the resulting from the seasonal shift in the earning is the average over the cash payment. The third is the retired manager will continue receive the payment for a number of years. The second kind of the compensation plan is the long-term compensation plan. Long-term compensation plan is related the value of price of share in the capital market. The fundamental reason for implementing this plan is the growth of the value of the company's shares capital indicate the company's long-term performance. The following are the form of the long-term compensation plans. The first is the stock option. Stock option are the right to buy a number of shares on or after a certain date in the future. The second is phantom share, a stock plan that reward manager with the number of shares in the accounting only. At the end of the predetermined period, the executive is entitled to receive an award in the form of cash or the share equal to the appreciation in the market value of the share at the date of award. The third is the stock appreciation. Stock appreciation is the right to receive the cash payment based on the increase in the value of share only after a gift until the specified period in the future. The next is performance of share. Performance of share plan reward a certain number of shares at the manager when the long-term goals has been reached. The last is performance unit. Award for performance is acceptance of cash is the cash bonus for the achievement of the certain long-term target. This plan combines the aspect of the share appreciation right and the performance share. This plan is useful for the companies that own little or no publicly traded stock. The next is we move to the point C, the influence of the executive compensation toward the earning management. The earning management is carried by management, namely by manipulating the amount of company's profit in general, with the aim of getting the large bonus or compensation. This is actually a moral hazard because the manager gets higher compensation but by manipulating or being dishonest. Healy, 1985, in his research entitled The Effect of Bonus Schemes on the Accounting Decision, predict that the manager tends to manage earning to maximize their bonus. There will get which has been regulated in the company's compensation plan. Healy research was only conducted on the companies whose the compensation plan are based on the amount of net income for the current period. Healy research is based on the bonus plan hypothesis in the positive accounting theory, which to expand the manager in companies have bonus plan in their compensation system are more likely to practice earning management. A Palestine 2009 examined the effect of ownership structure, corporate governance practice, and the bonus compensation or earning management. He found empirical evidence that ownership structure and proportion of the independent commissioner and bonus compensation had significant effect on the earning management. Another research has been conducted by Mukhsin-1710533001 2011 by examining the effect of the ownership structure, company size, corporate governance practice, and bonus compensation on the earning management. Mukhsin found that only bonus compensation the audit community had a significant effect on the earning management. A research conducted by Palestine and Mukhsin found that there are positive relationship between bonus compensation and the earning management. In addition, the effect of the compensation or bonus has also been explained in the positive accounting theory as stated by Watts and Zimmerman. In the positive accounting theory, there are three hypotheses behind the occurrence of earning management. The first is bonus hypothesis that's related to this paper. The company's manager will be given a higher bonus based on the earning using the more accounting method that can be increased reported earning. In the companies that have the bonus plan, the company's manager will be preferred accounting method that can shift the profit from the future to the present so as to increase the current profit. This is because the manager prefers to pay higher wages today. In the bonus contract, there are two terms known as bogey, the lowest profit rate for the getting bonus and the cap, the highest profit rate. If the profit is below the bogey, no bonus will be earned by manager, whereas if the profit is above cap, the manager will not get an additional bonus. So we come to the last chapter, chapter 3, the conclusion. Although the earning management practice are very contrary to the basic concept of the financial statement, managers still do it for several purposes such as compensation, debt covenant, and the others. But in PSAK number 1 or in the conceptual framework stated the information in the financial report must help user in the making decision. The information presented must be usable. This means all information presented in the financial statement must be relevant and faithful presentation. In accordance with the purpose of the financial statement, to assist the user in making decision. Is manager do earning management or manipulate the company's report? Of course, the financial statement no longer present the true condition of the company. In fact, in EASB, to avoid the earning management, is already required the company to carry out the full disclosure. As we know, the main motivation of the manager in carry out earning management is to get high compensation for their performance. As explained in positive accounting theory, managers to manage the shareholder will try to get high reward for the performance that will be used for their welfare. But maybe in reality, it's not all managers do the earning management because the compensation contract that has been agreed upon the company and the executive that will be motivate them to perform well. That's all from me. Thank you for the attention. Wassalamualaikum warahmatullahi wabarakatuh.